Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the double top and double bottom pattern. These formations are essentially for identifying potential market reversals. You would learn how to spot these levels, understand the significance, and develop a strategy to trade them effectively. So stay tuned to the end to gain a valuable insight that could enhance your trading strategy or your trading approach. First of all, we start by understanding what the double top and double bottom is all about. The double top and double bottom are classic reversal patterns that signals potential change in market direction. The double top forms after an uptrend showing two peaks of nearly the same level. As we can see from the chart, show two peaks and they form at the top of an uptrend, and they are separated by a dip. As we can see, there is a dip in price at this area, so they are separated by a dip called the neckline. So this dip is called the neckline. This pattern suggests that buyers or buying momentum is weakening and sellers are gaining control. On the other hand, we have the double bottom, and this appears in a downtrend. It appears after a downtrend, and with these two draws at the end of the level separated by a peak. This is the peak separating these two dip in price, as we can see. So this pattern indicates that selling pressure is fading and buyers are stepping in. This pattern are not just about shapes, but they represent shifts in market sentiment from a double top that the first peak from a buyers pushes price higher. However, after hitting a resistance, the price declines slightly before attempting for another rally to the upside. This is basically what it means. Price come from the downside to the upside. Sellers step into the buyer market, push price down. Price decided to go up again for one more try before eventually it drops to the downside. Sellers step in, fading out buyers from the market. The second peak always sometimes surpasses the first. Sometimes the second peak sometimes surpasses the first, and it confirms that buyers are losing strength. Similarly, for the double bottom, sellers drive price to the downside. When sellers drive price to the downside, they hit the support, and after a brief rebound, price rise to the upside and come back to test the support again before losing its strength completely, and buyers come in the market and dominate the sellers. Volume also play a crucial role in validating these patterns, and when we include our volume indicator, we would find out that the market showed volatility during that section. Volume come into play crucial role. For a double top, you often see high volume during the first peak and the lower volume during the second peak. So including when I put my volume indicator for better understanding of what is happening in present time, we would be able to see what the market is telling us. And as you can see, the volume is telling us that at the first peak we saw an increase in volume. At this area we saw an increase in volume, while at the second peak we see a little bit of reduction in volume. For a double bottom, volume tends to drop during the first drop. Volume tends to drop within the first drop, and let me add my volume indicator to make it easier for us to spot. During the first drop, volume usually drops, as you can see, while during the second rebound, the volume tends to increase, and as you can see, there is an increase in volume in this area. proving that buyers are coming into the market. There is an interest of growing buyers in the market. Remember, the neckline is another essential element of this double bottom and double top. It represents a key support or resistance level. A double top breaks below its trend line, below its neckline, and this is the neckline we are talking about. The neckline is this area where we expect price to break below. In a double top, price breaks below the neckline to confirm bearish sentiment and signal further down movement, while in a double top, this would be our neckline. This is our neckline, and we expect buyers to step into the market and break this neckline to confirm bullish sentiment and suggest upward movement. So by understanding this pattern, it helps you to recognize where the market sentiment is shifting to, and it prepares you for potential reversals. By focusing on these structures and accompanying volume changes, you can identify the formation with greater accuracy and confidence. Now let's see how we can apply this ultimate double top and double bottom trading strategy to our trading. The strategy begins by identifying a clear double top or a clear double bottom. When you identify this pattern on your chart, for a double top, you are looking for two peaks similarly in price levels. Remember, this trend must come after a strong, this double top must come after a strong trend to the upside. The neckline often acts as a support for the double top. The neckline acts as a support for the double top, while the neckline acts as a resistance for the double bottom. Once the pattern is identified, you have to focus on the break of the neckline. We have to focus on price breaking the neckline. Once this is confirmed, where market signals its intention to reverse, the double top, you wait for price to break below the neckline, indicating bearish momentum. While for a double top, while for a double bottom, we wait for price to break above the neckline. When price break above the neckline, it suggests bullish momentum. This break should be decisive with a strong candlestick movement with increasing volume. As we can see, the break had an increase in volume when it broke through this side, showing bullish momentum. While for the selling, when it broke through price, we saw an increase in selling pressure. This is when you would confirm that there is an increase in volume. After the confirmation of the break, you would enter the trade immediately after the neckline breaks to ensure you catch the move early. Alternatively, you can wait for a pullback to the neckline before the approach reduces your risks by confirming that the breakout was genuine. If you wait for a retest of the neckline, it confirms your approach was genuine. It's not always every time you see a neckline break and you see a retest, but if you want to capitalize and confirm your genuine move, you always wait for a retest of the neckline. Remember, these are not just lines, these are zones. These are trading zones. The neckline is a zone. So when you decide to take your trade, when price retests at that area, this is where we will decide to take our trade and enter our trade. Remember, risk management is essential in this strategy. You always set your stop loss just above the second peak in case of a buy sell trade, just above this second peak. This is where you set your stop loss. Measuring, you would have to get your stop loss. This placement minimize losses if market reverses against us. In terms of a buy trade, we would enter the moment. In this example, we can see that price did not really come back to retest the neckline. Profits are actually targeted from the measurement of the distance between the highest point of the double top to the neckline. You can measure the height from the double top to the neckline and project that as your profit target, which will give you a 1:1 trade, or you can aim for at least 1:2 as the case may be. So by following these steps carefully and applying proper risk management, you can trade these patterns efficiently and with confidence. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.